In today's video, I am going to be breaking down ZWT, which is, of course, a BMO ETF and a CI covered call called TXF, and these are both high dividend tech covered call ETFs. Let's get down, let's check them out. I really like both of these, but one of these is better than the other, so let's check them out. So the first one is ZWT, the BMO Covered Call Tech ETF. So the benefits of this fund is number one, it's designed for investors looking for higher income from equity portfolios. Second point is it's invested in a diverse portfolio of North American tech and tech-related companies. Third is it's a call option strategy that will allow you to have lower volatility, but also higher dividends. And of course, it is professionally managed by BMO. The nice thing with BMO is their covered calls are usually way out of the strike price, which will then generally allow you to keep your shares, or at least the shares of the stocks that are held inside of this ETF. So of course, first off, we want to look at the dividend. Is it a good dividend? Well, annualized dividend as of right now is 4.6%, which is really high when you consider it versus other stocks. However, when you consider it versus other covered calls, it's not very high at all. Its MER is quite high versus other ETFs. However, it's in line with other covered call ETFs, which is 0.73%, which means that if you were to put, let's say, $100 into this ETF every single year, you're going to be paying about 73 cents. And now, of course, if you add $1,000, it'll be $7.30 a year. And of course, that decimal point just keeps on moving depending on how much money you put into it. Now, the average market volume is extremely low of about 1,700 shares traded every single day. The nice thing, however, is they do distribute the dividend monthly, which means that you would essentially be looking at distributing the money and using it as essentially pays or regular pay towards your living costs. This is the type of fund that you would get if you were retired or you're looking to retire and you're looking to have income coming in. Now, as we can see, this is still a new ETF, but we can see that 13 cents every single month is pretty good. Its top holdings are Microsoft, Alphabet, which is Google, Facebook, Amazon, Apple, Visa, Nvidia, which is one that I really like, MasterCard, PayPal, and Adobe. In my opinion, the three best companies in here is Amazon, Apple, and Nvidia. Now, if you're really confused as to what a covered call strategy really is, really quickly, all it is let's say you hold, 1,000 shares, and then you can sell a call option to buy 100 of those shares in the future, let's say 2 months down the road. You can give that option to somebody to buy that stock at today's price 2 months down the road, but only if it hits that strike price. And let's say it's currently trading at $60, and you say, well, I can sell you those shares at $60 in 2 months, while that stock price may be worth over $80 a share. However, if they don't hit $80 a share, then what's going to happen is we keep the premium that you pay us, which let's say is $150. We keep that $150. That's our dividend. And then if it doesn't hit that $80 strike price, then we get to keep the shares and you get nothing. That is essentially what a call option is. What a covered call is just you hold the shares and that's what you're selling the call options against. I hope that sort of explains it. It's a very brief overview, but I've got a real overview on this channel. If I remember, I'll stick it up somewhere. And this hasn't been around for a long time. It's been around since February, and where it's gone from is around just under $30 to now being worth $34, which is a little over 10%. It's more like 12-13% return since the inception, which was less than a year ago, really, but it's only been a couple of months. Meanwhile, TXF, it's been around for a lot longer. We know the history of this one at least, and the ticker is TXF, and this one has a ridiculously high yield of 10.7%. So right off the bat, if you are using this for income, this is going to be a better option because it gives you more money. However, there's going to be a reason why I also say that the other one, ZWT, may be also better as well. So we'll stay tuned for that anyways. But this one's average volume is 43,000 shares traded every single day. So it's a lot more liquid. You can buy and sell this one a lot easier. So for example, the other one only trading at 1,700 shares a day means that if you were looking to buy, let's say, 500 or 1,000 shares, it will take a very long time to buy and a very long time to sell if you're looking to trade those higher numbers. However, if you're looking to buy that much at the same time, and you're looking at an ETF that has 43,000 shares on average traded every single day, then at that point, it's going to be easier to buy and sell 500 shares at a time, so keep that in mind. This one's expense ratio is a bit lower at 0.71, which is about 0.02% difference in the grand scheme of things. If you've got over $1,000, that's when that MER really starts making a difference, when you're comparing a 0.02% difference. Now, year to date is a 13% increase, which is what we see with ZWT as well. Now, when we look at the max chart, we're looking all the way back to 2012, and we can see that this has had a nice run since 2012. It's gone from about $10 a share to $21. It's doubled in that 8 or 9 year period, and you're looking at something that, sure, you're not getting ridiculously massive growth in 8 or 9 years. You're doubling, which most stocks will double every 5 years or so. However, what you're looking at is something that will pay you over 10% dividends. That's just insane. That's amazing. That basically means that 10%, I know I'm rounding down a bit, but at 10%, if you put $10,000 into, let's make this better. Let's say we put $12,000 into this ETF. That means that you're getting paid $1,000 a year. Yeah, that is amazing. And let's say you put that $12,000 in here and said, well, I'm just going to let it sit there for, let's say, 24 years. Well, guess what? That 24 will turn into, or that 12 will turn into 24, and then it's going to then essentially, in theory, turn into $48,000 within that 24-year period. So if you are 30, like I am right now, I'm 31, but let's say I'm 30, and you wanted to retire in your mid-50s, then if you were to put $12,000 into this today, in theory, you would have $48,000, and if it's still paid that 10% at that point, you would then be doing about $4,800 in theory, this is only theory, a year by the time you're in your mid-50s. Now, of course, you'll have other stocks, other ETFs by that point in time, but that is a considerable amount of money in 24 years even, considering that you have that much growth and that much dividend by that time. And if you use the dividend that you got through those 24 years and you invested it into other ETFs that paid 4, 5, 6%, or even other stocks that paid 3 or 4%, you're now looking at a fantastic retirement, and you're only really starting with $12,000. Now, the thing with this ETF versus ZWT, and what makes ZWT better is, for one, ZWT pays monthly while TXF pays quarterly, so that's number one. Number two is the fact that ZWT, their dividend is different every single month. It really comes down to how much or how many of those calls get sold. Those call options that get sold, this is where you're making your call option money from, the premium they call it. So overall, if you were looking for essentially bigger growth, because we don't necessarily have a history on ZWT, and you're looking for a higher dividend, then TXF is the one to go with. If, however, you're maybe retiring this year and you're looking for something that will give you a monthly income, a lot of BMO covered calls are a great option, but ZWT, if you want to have diversity, and of course this is a tech covered call, this could give you the diversity that you're looking for while still getting that dividend. Anyways, I hope that this video has helped you. If it has, hit that like button, subscribe. But as for which one is better, it really comes down to your own personal situation. Anyways, I hope that you've enjoyed, and I'll see you guys again in my next video.